I'm not sure, because it certainly isn't using any kind of economic history and or economic teachings. And right now, companies are struggling to pass through input inflation. Surely there was a chapter, I think, that the administration is looking back on during the pandemic when the stimulus money was flowing. And it was really easy to raise prices and pass them along. And everybody was going along for the ride, including the consumers. Because they were flush with cash, and they weren't used to being flush with cash. The stimulus monies were inappropriately given out to people who definitely didn't need them. So in many ways, that's why a lot of companies were able to price up. That's no longer the case. The pricing power is no longer there. The one example that it's easiest to point to, because it's such a massive company, is Amazon swinging from an $8 billion profit in the fourth quarter of 2021, and then swinging to a nearly $4 billion loss in the first quarter of 2022. That tells me that if the administration is to try and push forward with raising taxes, that really it's the consumer who would end up paying the price, because if they're already operating at a loss, what are they going to do if there's some type of minimum income tax that's assigned, minimum corporate tax that's assigned? It absolutely makes no sense, but it's good for sound bites. And it's good for riling up the public and getting them angry against those big, bad, big, fat corporate chieftains. I get that.
Mm-hmm. So if we see the tax hikes go through, what are the most likely consequences that we could see for the public? Are we likely to see more layoffs?
We would see more layoffs, but I think we're getting ahead of ourselves here, because I don't think that anything of this nature is going to happen until February at the earliest, when there's a new Congress in office. And if it is February, that's assuming that the Republican Party falls completely out of bed and does not end up with the results that are being expected, because the Democratic Party has so messed up, the first 2 years. But by the time we get there of this administration, I suspect that we'll be in recession on election day. And that's not an enviable position for the incumbent party. We could be having the same exact conversation, and the shoe could be on the other foot. We could be talking about the Republicans being in the incumbency and them having messed up the economy. Nobody wants to be the person who is voted out because of their policies.
Mm-hmm. So do you have an explanation for why it took so long for Powell to be confirmed for his second term here?
I have absolutely no explanation other than pure politics. And politics are not supposed to be what drives certainly the confirmations of individuals who are by law independent and apolitical. Mm-hmm. That is the verbiage of the Federal Reserve Act of 1913. The fact that they kept Powell's confirmation held hostage until a tie-breaking vote was cast by Vice President Kamala Harris to get Lisa Cook confirmed to the Federal Reserve Board is indicative of how far astray the current administration and the current Congress have gone when it comes to abiding by the letter of the law. So Federal Reserve Board members are not supposed to be confirmed along party lines. That makes them by definition not apolitical and not independent. And we saw Lisa Cook was 51 votes. Lael Brainerd was 52 votes. Those are two individuals who are not going to be as effective as individuals on the Federal Reserve Board going forward, because their peers within the Fed are going to know that their appointments are somewhat tainted. They didn't get the 80 votes that Jay Powell got when he finally was voted on by the Senate. And that is indeed the spirit of prior confirmation votes, that you get at least a 66, an overwhelming majority of those Senate votes.
And does that not make for, in some ways, a moot point in a dynamic where Jay Powell has the veto authority, regardless of who else is on the board?
Yes. In essence, what you're talking about now are people who can make noise, but not make a difference. Mm-hmm. Because at the end of the day, it is the chair who has the ultimate authority. And in the case of Jay Powell, if we've been listening to him for these last few weeks, sounding very tough, my guess would be that he's going to be very disregarding of a lot of the politicking that was going on prior to his being confirmed to a second term. And I'm not inside the Eccles building. I'm a former Fed insider, but I venture to say that there is probably a lot of animosity as well among the staff because policymaking was held also hostage. And we've heard this from Randy Quarles, who was at the Fed, who stepped down early. His term didn't end until the year 2032. And he's come out and said flat out, we would have raised rates earlier. We would have been more preemptive in getting front of this inflation had there not effectively been this leadership crisis within the Fed, which the administration played a part in.
So now that he has been confirmed, Danielle, has he become even more hawkish?
That certainly the tone is that he's more hawkish. That is certainly what we've heard from him. And he is more resolute since the day he was confirmed. When he came out and did an NPR Marketplace interview, he's spoken since as well and invoked Volcker's name, I don't know how many times, and actually used the words, we can't fail, quote unquote, can't fail. We can't fail to get inflation under control. So he's certainly striking a more hawkish tone. We will see how serious he is as the credit markets, not necessarily the stock market, but as the credit markets push his limits in terms of what he's able to withstand because of the risk. The higher the risk is of defaults growing in credit, the greater the potential for not just real economic fallout, but also the potential for systemic risk, which is something that's out of any central banker's control.
So as the inflation will be transitory narrative has fallen apart, what steps do you think would be most prudent to actually help ease inflationary pressures? It seems like raising rates and balance sheet runoff is more of an indirect and ineffective tool for fighting the actual supply side inflation that we're seeing.
So fighting supply side inflation is just about impossible. I mean, the monetary policy, whether you're talking about quantitative tightening, rolling off that balance sheet, or raising interest rates, neither of them really can help to get under control, how much consumers are spending on energy or groceries. These are things that are largely exogenously dictated, supply chain disruptions and what have you. That said, any household's given budget, the largest line item in there is housing. So if he wants to break the back of housing by reducing aggregate demand, by tightening financial conditions, he can do that. And he knows he can do that. So there are certain things that are under his control. Sadly enough, it is largely at the Fed's doorstep that inflation in housing got to be as bad as it is today. When you keep interest rates at the zero bound for as long as the Fed did, you encourage speculative risk taking on the part of investors. And that's exactly what we've seen with investors making all cash buys, about a third of all housing transactions, including in the new home market.
So you and I have spoken before about how CPI actually works as a year over year comparison. So is it possible that we start to see the overall inflation rate of change come down just because of that comparison?
Well, ironically enough, housing is going to continue to provide upward pressure on CPI going forward because housing filters through to the consumer price index with a big lag. So the last print that we had, the most recent print that we had, the year over year shelter inflation print was higher than at the peak of the last housing bubble. Hard to believe. We expect for that to continue to increase. Where you can look for downside is what people really cannot afford. And once you start by process of elimination to say housing, energy, the air conditioners are going to be running this summer, groceries, the crops aren't coming in like we would like them, potentially. Once you factor these three things out, vacations, shopping, apparel, cars, the discretionary type of purchases, that's where you're going to see the real downside. That's where you're going to see the disinflationary impulse that does indeed bring down your monthly prints, because American households, in the absence of further stimulus, which I don't think is coming, American households simply cannot afford to splurge and buy what we would consider to be discretionary items, whether they be in goods or services.
So if we actually see the inflation rate ease, but price levels remain high, is it ever possible that the absolute price levels come down?
Well, I mean, look, when it comes to things like food, you're really only ever one season away from potential Armageddon or absolute relief. You just need a good harvest, right? And as it pertains to energy, by all of the purchasing managers' indexes expected out for the United States and all across Europe, 15 of them, I saw on Bloomberg, all 15 they're anticipating show contractions for the month of June when these prints hit. That's extraordinary. Mm-hmm. So what you're saying is the United States is heading into recession. You're saying Europe is in or heading into recession. China is as close as we'll ever see it be, given the lockdowns. All I'm trying to say is at some point your demand is hit enough. If you're talking about a global recession, the Institute for International Finance came out and said, we expect a global recession to arrive in 2022. That translates into demand destruction for oil. And there's no two ways about it. You can't be the Griswolds and set out to see the great American West in the gas guzzling SUV if you don't have the money, if demand is being destroyed. So the idea that supply and demand has somehow been broken, that's false. Mm-hmm. So we could see downside in energy and we could see downside in grocery inflation. It's just going to happen with a lag, exacerbated by the fact that housing was allowed to run rampant for as long as it did. And that type of inflation takes a long time to come down. Think about a lease for an apartment, 12 months in length.
So while we've seen some energy companies making record profits, are they reinvesting these profits in expanding supply, or are these companies really threatened by the current administration and therefore not really willing to reinvest at this point?
Well, we've certainly seen a reluctance, and we've seen a justifiable reluctance on the part of these companies because they're being told that if they do make these investments, and these investments are very long-term in nature, you're not depreciating the asset over the space of 2 or 3 years. You're talking about a decade or more. But they're being told, if you make these investments, we're going to penalize you. We're going to try and regulate you out of existence. Mm-hmm. And this actually came up with a very contentious Fox News over the weekend piece that I did with somebody who had a fundamental misunderstanding. They're trying to gouge people. They're trying to take profits. And I'm like, no. The CEO and CFO, the board, they'd all get fired if they were making investments based on return on assets that weren't going to work. It's simply not how. Now, I will say this much. We have indeed seen a major uptick in rig counts. So to that extent, to the extent that energy companies were ready to tap wells, pre-existing wells, and pull out as much energy as they could, pull out as much fuel as they could out of the ground, we've seen that, which is rational because the administration has gotten into a very good habit of speaking out of both sides of its mouth and saying, well, you got to drill, baby, drill, but we're gonna penalize you for it in the future. The swing factor, I think, right now is that it does look like Congress is going to flip, and that would be much more energy friendly, at least in the near term.
Right. So, considering how big of a piece that energy is playing in inflation right now, is there any point in trying to combat high energy prices in the near term? Or do you think that the recessionary risk and that demand destruction is going to take care of that in and of itself?
Well, that's the way it's typically worked, unless we've rewritten the rules. So, right now there are certain idiosyncrasies that are making it much worse for airline travel, for example, because diesel refining capacity for truckers, jet fuel capacity. There are a lot of individual episodes going on right now that are making it more difficult and more costly. That being said, you're also seeing that a third of Americans are planning to not use air travel, whereas they had been thinking to go that route before. Mm-hmm. So they're saying, family of 4 times 600, not working. So we either drive, go closer, but we're not flying. So again, supply demand.
Right. So as a former Fed insider, Danielle, is this a time that makes you glad that you aren't in that position anymore?
I was never glad to be in the position in the first place. I was fighting the good fight. Glad is not a word I would have ever invoked. Mm-hmm. No, I don't envy. I don't envy the current leadership because of the current leadership. They've made their proverbial bed of nails, mm-hmm. and now they're lying in it, and it's uncomfortable. But again, these are. It started with Alan Greenspan. Paul Volcker could have given a crap if the S&P 500 was falling out of bed. And that was always his attitude. But beginning with Alan Greenspan, the Fed became increasingly a political instrument. And now it's blatantly, it's as if it's a cat playing with a mouse. And the mouse is the Fed, and the cat is the administration and Congress. So this is the price they pay for having become so amenable to being politicized from Greenspan, through Bernanke, through Yellen, and sadly enough, through Powell, who, as a non-PhD in economics, should have known better. He should have known that manipulating the markets to the extent that the Fed was going to have vast repercussions. And now he has to make the choice of, do I back down and potentially inflate this bubble that is very obviously a bubble further? Or do I have to, or am I forced to put the US economy into recession? Because those are the only two choices he has. There is no in-between, soft landing, gray area, kumbaya, Goldilocks outcome. Not happening. It's just not happening.
So we have seen the markets react quite violently to the rate hikes that we've already seen. So what is Powell looking for before he decides to have to reverse course? What will have to break for him to change direction?
I think to say that credit breaks would have to be credit breaking to where it was systemic in nature. And I've been saying this over the past few weeks until I'm blue in the face, and people are like, well, what does that look like? And I'm like, well, it kind of looks like an implosion where you don't get to sleep. You don't get to go to sleep because you have to watch Asia, because you don't know how Asia is going to affect the United States or Europe. You don't know what contagion is going to, how it's going to manifest. If this is a controlled demolition, and if it's just one bad company at a time that's filing Chapter 11, that's gotten over its skis and over indebted, I think Powell goes along for that ride. If it's controlled, if it's orderly, even if it's ugly, even if we're in recession. But if it comes to the point where it's systemic, then it is a great big no-no for any central banker to say, well, we'll just let global systemic risk ride, and we'll just ride out that depression. Because that's the difference between a recession and a depression, is when you introduce the element of financial crisis into it.
So would the unemployment rate ticking up be one of the most important pieces that he's looking at as well?
Only if he continues to drive using his rearview mirror, which is never safe. Because the unemployment rate is the most lagging of all economic indicators, period, end. We've already seen upward revisions to the last 2 months of non-farm payrolls. We've already seen a bottoming out as of March 19th in jobless claims. We've seen Indeed.com job postings come off their lows. 22.5% of American companies right now have pulled their job postings. So if he wants to wait to see the whites of the eyes of the unemployment rate, God bless him, because that's the last place that you see evidence of a turn in the labor market. But there is ample anecdotes and evidence that we have indeed seen the turn, starting with Amazon's layoffs, but percolating all the way through Silicon Valley as well.
So to that point, Danielle, as you talk about him driving by his rearview mirror, when we think about many of these metrics that the Fed looks at, whether it be CPI, unemployment, or housing prices, many of these metrics are really lagging indicators. So do you think that there's any better way to be able to make decisions based on a data collection of more real-time data?
Well, that was certainly the good fight that I fought for 9 years when I was inside the Fed. I was always trying to introduce more real-time metrics, because that's how you make policy. You make policy by looking out of the window of the car, not looking behind it. And again, I will go back to Jay Powell's roots as an investment banker, as a private equity banker. He understands that there are many other ways to look at the world, rather than saying there are 2 job openings for every there are 2 job openings for every warm body. That is the most lagging of all indicators, the JOLTS data, the job openings layover survey data. So he should know better, such that he's able to look and see the real-time data, because there is ample rich sources of real-time data, especially, by the way, in a post-pandemic world, because so many have been created to track the economy in real time. Google search is something that anybody has on their phone. You can do a Google search and see if recession is trending, and see if unemployment searches are trending. So he has ample evidence. Will he use it?
So when we think about all of these pieces of data that he can look at to make decisions based on, If we see, some decent relief rallies in the stock market at this point, is he going to act on those, or does that further reinforce his narrative at this point?
I think that any kind of a risk rally, especially a rally in stocks that bleeds through to high yield and investment grade spreads, it kind of takes the boil off of, oh gosh, are we at that Rubicon in credit? I think all of these are going to be welcomed with open arms by Jay Powell, because it's licensed for him to push forward with that June the 1st launch of quantitative tightening, where we're going to see a staged in 3-month approach until we hit that $95 billion a month run rate come September. It will embolden him to push through with that rate hike in June and then again in July. The more well-behaved the financial markets are, the greater the latitude Jay Powell has to push through with this measured, orderly rate of tightening. And that's what he's really hoping for. He's hoping that he gets orderly, not disorderly.
Mm-hmm. And again, to that point, Danielle, is the negative wealth effect that they are wanting to create here something that they think they can control quite well, or are they really scared of creating that real demand destruction?
Well, again, it's the systemic risk that they're trying to prevent. Negative wealth destruction, the reversal of the wealth effect, they actually welcome that and want that. Going into a midterm election as we are, there's a bullseye on the Fed because it's obvious that their policies have benefited the 1%. So to suggest that they would be remiss to see the stock market come down right now, no, they actually welcome it. Mm-hmm. And they welcome the fact that second home sales are no longer at a high boil as well. So they're at the juncture that they know that there's a stain on the policies that they have made. And even though you can say, gee, these are all of his buddies in private equity, what if the IPO market continues to go into a deep freeze? What if high yield bond issuance continues to be very, very stunted? It's down 75% year over year. These are the exit vehicles for his buddies in private equity. And right now the exit's closed. Mm-hmm. So, but for him to be perceived as kowtowing to pressure is just not ideal.
Mm-hmm. So I had a listener propose the following situation. I'd like to get your thoughts on it. So if the Fed hikes 50 basis points in June and or July, then it pauses due to sharply deteriorating economic data, but decides to continue quantitative tightening. Would this be the only way of creating bidders for the assets it is selling due to the rate hike pause, while allowing balance sheet reduction without creating a sell-off in the treasury market, keeping yields stable?
I mean, that's a big question. And it's a big question I cannot answer. Mm-hmm. And that is, to me at least, that is why the quantitative tightening element, that's why that piece of the puzzle is it's the least known of the knowns. We know for a fact that markets did not like the Fed's balance sheet shrinking alongside Jay Powell's first attempt to raise rates concurrently. The markets did not like that. We know that deposit growth at banks has collapsed. It's about 1%. It's about a quarter of what it was. We know that if you follow the Fed's H8, which I highly recommend, every Friday after the close, it's released. It provides a snapshot of other deposits under liabilities. That's turned negative year over year. We're about to see M2 money growth turn negative year over year. Why do I bring up all of these arcane signposts? Once you start to see liquidity turn negative, all kinds of things can start to go wrong. And you don't know where it's going to occur because we've been living on abundant liquidity. And abundant liquidity can feed into all kinds of speculation and happy growth and the biggest tech stocks and FANGs and SPACs and NFTs and cryptos and you name it. We get that. But pulling liquidity back, we don't know what that's going to look like. We just know that we're already at a point of demarcation and that we've gone from positives to negatives starting. The markets are not going to like that.
Mm-hmm. So you've touched on many times today about the housing market And I've heard you speak before and say that we're in one of the biggest housing bubbles that we've ever seen at this point. So is there a major risk of a housing crash like we saw in 08? Or considering that the risks are much different this time, that it won't be nearly as dramatic?
Well, it's hard to say because you don't have individuals who have taken out 5 loans and they've got, an income of $40,000 and somehow, some way they've talked some mortgage lender into committing fraud so that they could qualify. You don't have the same dynamics in the housing market that you've had before. You do have intense and immense speculation. And we've seen that. We're also seeing companies try their best to bring their employees back into the office. And in fact, I heard an interesting anecdote that a buyer outside of Austin, Texas, which has been one of the hottest housing markets in the country, was told by his employer, well, we're rethinking our work from home strategy. We're beginning to think that we're going to want our workers, or at least the ones who want to continue working for us, to be in the office 5 days a week. Mm-hmm. That person decided to not buy as big of a home and not spend as much as they would otherwise, knowing that that their home was not also going to be a home plus office. Mm-hmm. So as you fall into recession, the chances are that a lot of the factors that were feeding into extraordinary home price gains won't be there anymore. You might be working from home, but you might be working from home for yourself. So to put it bluntly, and we don't know how investors are going to react. We don't know how mom and pop investors, all the way up to the Blackstones of the world, we don't know how they're going to react if we start to see home prices tick down and pressure on them to where they can't get 18, 17% increases on new leases if the money's simply not there and people have to go rent elsewhere. What are they going to do with these massive portfolios of homes that they're sitting on if their investors start to get itchy? Mm-hmm. So is there more leverage backing the current housing bubble? Absolutely. But it's in the hands of investors. And we have to wait and see how people react to home prices beginning to pull back. CoreLogic, I'll give you one little, in the month of April, they said that 13% of US communities were at risk of home price declines in the coming 12 months. By May, that had ticked up to 28%. So the downside is definitely building for housing because while we haven't seen speculation in the sense of mortgage financing for individuals, we have seen home prices run up to a much greater extent than we did in those years. I think the average, according to Redfin mortgage payment, is up, I think 43, 44% in the last 12 months. Mm-hmm.
And how does the supply and demand dynamic within the housing market also have a role to play in that as well?
Well, it has a pivotal role to play. You have to bear in mind that the population growth of the United States in 2021 was the lowest in the history of the country. California saw net negative. It saw net out migration. And if you look at the millennial generation, the ones that are at their core home buying years, that cohort, they're growing at about 1.2% per annum. Back when the baby boomers were flooding into the housing market and they were an economic force to be reckoned with, back in that same parallel cohort was growing at 4.5% per year. So the growth rate of the population is what determines how many homes you need. And right now, it looks like, despite the fact that there are more homes under construction, single family, than in any year since 1973, it looks like the population growth is not going to be able to sustain what's coming online. The next time that we speak, we could be easily having a discussion about oversupply of housing. And that's something that would be very new to the discussion.